Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 2 of understanding the Sharpe Ratio, key to smart investing. Risk-adjusted returns of Sharpe Ratio. The Sharpe Ratio enables investors to assess the returns generated by an investment in relation to the level of risk taken to achieve those returns. By taking into account the volatility of an investment, this metric provides a more comprehensive perspective on performance beyond just looking at raw returns. Investors can use the Sharpe Ratio to compare different investment opportunities and determine which ones offer the best risk-adjusted returns. Portfolio diversification strategies. Diversification is a key strategy in reducing investment risk, and the Sharpe Ratio can help investors in constructing a well-diversified portfolio. By considering not only the potential returns of individual assets but also the correlation between them, investors can use the Sharpe Ratio to optimize the risk-return profile of their portfolio. A higher Sharpe Ratio indicates better risk-adjusted returns, highlighting the effectiveness of diversification in managing overall portfolio risk. Performance evaluation and benchmarking. When evaluating the performance of an investment or a portfolio, the Sharpe Ratio serves as a valuable tool for benchmarking against a chosen reference point, such as a market index or a specific investment goal. By comparing the Sharpe Ratio of an investment to its benchmark, investors can assess whether the returns achieved justify the risks taken. This metric provides a standardized measure to evaluate performance consistently and objectively, helping investors make informed decisions based on risk-adjusted returns. In summary, the Sharpe Ratio is an essential metric for investors looking to make informed investment decisions. By considering risk-adjusted returns, leveraging portfolio diversification strategies, and using it for performance evaluation and benchmarking, investors can enhance their decision-making process and strive for optimal risk-adjusted returns in their investment endeavors. Limitations of Sharpe Ratio. Sharpe Ratio, a widely used metric for evaluating the risk-adjusted return of an investment, has its limitations that investors should be aware of. It's crucial to understand these constraints to make informed investment decisions. Assumptions and criticisms. One of the primary criticisms of the Sharpe Ratio is its assumption that returns are normally distributed. In reality, market returns often exhibit fat tails and exhibit more extreme values than a normal distribution would predict. This can lead to inaccuracies when using the Sharpe Ratio to evaluate risk-adjusted returns. Another common critique of the Sharpe Ratio is its reliance on historical data. By looking at past returns, the Sharpe Ratio may not account for changing market conditions or unexpected events that could impact future performance. Investors should consider the limitations of historical data when using the Sharpe Ratio as a measure of risk-adjusted return. Alternative risk measures. To complement the Sharpe Ratio and gain a more comprehensive view of risk-adjusted performance, investors can consider alternative risk measures. One such metric is the Sortino ratio, which focuses on downside risk by only considering the volatility of negative returns. Unlike the Sharpe Ratio, the Sortino ratio does not penalize upside volatility, providing a different perspective on risk-adjusted returns. Additionally, investors can look at the information ratio, which evaluates the risk-adjusted return by comparing the excess return of an investment to a benchmark relative to the tracking error. This metric can help investors assess whether the active management of a portfolio generates returns above the benchmark after adjusting for risk. By understanding the limitations of the Sharpe Ratio and exploring alternative risk measures, investors can enhance their ability to evaluate the risk and return profile of their investments effectively. Sharpe Ratio is your go-to metric for smarter investments. It helps you measure the return of an investment compared to its risk. A high Sharpe Ratio means better risk-adjusted returns, showing that your investment is worth it. Always compare Sharpe Ratios to similar investments to get a clear picture. Use it alongside other tools, but give it weight in your decisions. Your portfolio will thank you. Provides a clear measure of risk-adjusted returns. Developed by Nobel laureate William F. Sharpe, this ratio helps investors evaluate the performance of an investment compared to a risk-free asset, after adjusting for risk. The Sharpe Ratio is calculated by subtracting the risk-free rate from the investment's return and dividing the result by the investment standard deviation. A higher Sharpe Ratio indicates that an investment offers better returns relative to its risk, making it a valuable tool for comparing the risk-adjusted performance of different assets or portfolios. For investors, the Sharpe Ratio simplifies the complex relationship between risk and return into a single, comprehensible metric. By focusing on risk-adjusted returns, it enables investors to identify investments that offer the best potential for return relative to the level of risk taken. This is particularly useful in portfolio management, where diversification and risk management are crucial. Moreover, the Sharpe ratio aids in optimizing portfolios through modern portfolio theory, MPT. Investors can use it to construct portfolios that maximize returns for a given level of risk, enhancing overall portfolio efficiency. In conclusion, the Sharpe ratio is a key tool in smart investing, providing essential insights into the risk-return trade-off. By leveraging this ratio, investors can make more informed decisions, optimize their portfolios, and achieve better risk-adjusted returns, ultimately guiding them towards their financial goals with greater confidence and precision. The Sharpe ratio is an essential metric for evaluating the risk-adjusted performance of investments. It offers a clear perspective on how much return an investor is receiving for the level of risk they are taking. By understanding the Sharpe ratio, investors can make more informed decisions about their portfolios, aiming to maximize returns while managing risk effectively. Developed by William F. Sharpe, the Sharpe ratio is calculated by subtracting the risk-free rate from the return of the investment and then dividing this result by the standard deviation of the investment's excess return. The risk-free rate is typically the return on government securities, such as U.S. Treasury bills, which are considered free of default risk. The standard deviation measures the volatility of the investment's returns, indicating how much the returns can deviate from the average over a period. A high Sharpe ratio indicates that the investment has achieved high returns for a relatively low level of risk, making it an attractive option for investors. Conversely, a low Sharpe ratio suggests that the investment's returns do not justify the risk taken. For instance, if two investments have the same return, the one with the lower volatility, and hence higher Sharpe ratio, is preferable as it implies a better risk-adjusted return. The Sharpe ratio is particularly useful for comparing the performance of different assets or portfolios. By considering both return and risk, it provides a more comprehensive assessment than simply looking at returns alone. This makes it invaluable for portfolio management and optimization, allowing investors to build portfolios that align with their risk tolerance and investment objectives. Investors often use the Sharpe ratio in conjunction with modern portfolio theory, MPT. MPT seeks to construct an optimal portfolio that provides the highest expected return for a given level of risk. The Sharpe ratio helps identify these optimal portfolios by measuring how well an investment compensates for its risk. Portfolios that lie on the efficient frontier, a concept from MPT, typically have the highest Sharpe ratios for their level of risk. Despite its utility, the Sharpe ratio has some limitations that investors should be aware of. One significant limitation is its reliance on historical data, which may not accurately predict future performance. Market conditions can change, and past volatility may not reflect future risks. Additionally, the Sharpe ratio assumes that investment returns are normally distributed, which is often not the case, especially for investments with skewed returns or those subject to fat tail events. Another limitation is that the Sharpe ratio does not distinguish between upside and downside volatility. Investors are generally more concerned with downside risk, the potential for losses, than with overall volatility. Alternative measures like the Sortino ratio address this by focusing only on the downside deviation, providing a more targeted assessment of risk-adjusted performance. To address these limitations, investors should use the Sharpe ratio alongside other risk metrics and qualitative analysis. Combining it with measures like the Sortino ratio, alpha, and beta can offer a more nuanced understanding of an investment's risk and return profile. Additionally, considering qualitative factors such as economic conditions, industry trends, and the financial health of individual companies can further enhance investment decisions. The Sharpe ratio is also valuable in performance evaluation and fund selection. Investors can compare the Sharpe ratios of various funds or investment strategies to determine which ones have delivered superior risk-adjusted returns. This is particularly useful for assessing active managers who seek to outperform the market through strategic investment choices. A higher Sharpe ratio indicates that the manager has been able to achieve better returns for the level of risk taken, making it a key metric in fund analysis. In portfolio management, the Sharpe ratio can guide rebalancing decisions. As market conditions evolve, the risk-return profile of a portfolio may change, leading to a shift away from the desired level of risk. By regularly calculating and monitoring the Sharpe ratio, Investors can identify when their portfolio has become too risky or too conservative and make adjustments to realign it with their risk tolerance and investment goals. In conclusion, the Sharpe ratio is a critical tool for understanding and managing the risk-return trade-off in investing. By providing a clear measure of risk-adjusted performance, it helps investors make more informed decisions, construct optimized portfolios, and evaluate investment strategies effectively. While it has its limitations, when used in conjunction with other metrics and qualitative analysis, the Sharpe ratio remains an indispensable component of smart investing, enabling investors to navigate the complexities of the financial markets with greater confidence and precision. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.